When you look out to the horizon, what do you see? What does tomorrow look like? If you run a family-owned business, you see the future differently. As part of the fourth generation of my family to help lead First Bank, I know we see the future like you. At the First Bank Center for Family-Owned Businesses, your vision is ours. Now, let our experience be yours. In this seminar, let us help you see what your future can be.
Good morning, everyone. Thanks for joining us today. We've got a great lineup of guest speakers. Paul Klug from Polsinelli and Bryan Graiff from Armanino will help guide a discussion on whether your family should look to acquire other businesses. There's many reasons for doing that, whether it's to vertically integrate or acquire a competitor, geographic expansion in the marketplace, take advantage of your depth of management within your family business, or just find a new business to diversify the family's revenue stream. So Paul and Bryan will go through that, and please send in questions, as Mike said, when the questions come in. If it's timely, we will get them right to our experts. And now, without further ado, I'd like to introduce Bryan Graiff from Armanino to talk about Armanino, what Bryan does, and his thoughts on whether your family should invest in additional businesses. Bryan, welcome.
Hi, Joe. Thank you. Glad to be part of this series and seminar to kick things off for the families that are looking to diversify and buy businesses. Just a little background on myself. I'm the partner in charge of transaction advisory services and the private equity industry group for Armanino. Armanino is a top 20 public accounting and advisory firm with 23 offices located around the country and almost 3,000 employees, providing audit, tax, and a multitude of consulting services, including a large presence helping wealthy families, family offices, business management, and a whole array of those things. And I think with my private equity background and the transaction advisory background, where we do both buy and sell side, I think hopefully I can help the family navigate the things they need to help diversify their wealth or look to make investments in businesses. Just a couple of quick things that I've seen in the industry lately, especially in the last 5 to 10 years. Families are starting to buy more businesses. They've historically always diversified their investments in equity markets, investing in private equity firms, investing in real estate. I think a lot of families have realized they did such a good job running their own business and sometimes selling that business to provide liquidity that they might as well invest in what they do best and put trust in themselves to run a business versus giving money to a PE firm or a larger family office to invest that money. So we're seeing a lot more families setting up family offices. I know there's a series on that later. We've actually, I've attended a seminar last year where the speaker said there are now more family offices buying businesses than private equity firms out there. And that's going to change the dynamics as your customers and the people on this seminar are thinking about how to prepare to buy a business. There's a lot of competition in the marketplace. There's a lot of dry powder on the sidelines. And so it really takes a strategic effort to go out there and make sure you're buying the best businesses that you can be successful with.
Sounds great, Bryan. Thanks. And next, Paul Klug. Paul joins us from Polsinelli. Thanks for being here today, Paul.
Thanks, Joe and Bryan. It's great to be here. Good morning, everybody. My name is Paul Klug. I'm an attorney with Polsinelli. Polsinelli is an AmLaw 60 law firm. We have almost 950 lawyers now going coast to coast, several offices in California, and a good centric focus on the middle part of the country as well. My practice involves a lot of representing family-owned businesses and pretty much everything they do. My forte is definitely on the transactional side. So if they're acquiring or selling or trying to grow through acquisition, if they're bringing in new family members are exiting, anything that really affects ownership and or management from a transactional perspective, I'm usually involved. with regard to, what's going on in the market and, how does the family business fit into being on the acquisition side, I would have to agree with Bryan. We've seen more and more of that in the last several years. For those of you who participate in the M&A markets, it's been extremely hot market over the last 2 to 3 years, especially with an extremely hot market late last fall, third and fourth quarter of last year. While there's been a little bit of a pullback this year, I think everybody still seems optimistic that the M&A markets are going to continue. One big reason, and Bryan mentioned this, and Joe mentioned as well, is private equity. And so private equity has a lot of money on the sideline, and that money needs to be deployed. So what does that mean for you? That means, you will be competing with those kind of firms for acquisitions. You'll have to better define and differentiate yourself from a PE firm. PE firms have certain hold periods. PE firms have certain goals with respect to financials and cost management. That might be a little bit different for a family-owned business. The longevity of ownership, additional investment in that business without necessarily having immediate return on your money. So those are just a few things. Joe mentioned some reasons why you would be acquisitive. One thing I would add is acquisition of talent. We see, acquisitions, driven by a lot of different things, but we also see talent as sort of creeping its way up to a priority on the acquisition side. So with that background, I'm looking forward to participating in a discussion, answering, for those of you on the video, answering your questions. Joe, I'll kick it back to you.
Sounds great, Paul. Thanks, and thanks, Bryan. Paul, when in your experience, do you see companies stay within their industry and expand geographically or take out competitors, or are you seeing more vertical integration as being the driver?
So, Joe, I would say we see both. I'd like to say one sort of leads the other, but I'm not sure. It depends on the sort of the focus of the business. Acquiring competitors can be a little touchy from a diligence and sharing information perspective. How do you approach them? What if they think you're in the market for buying? What if they think you're in the market for selling? So from a competitor perspective, we try to put some safeguards around those deals. And if that's really the goal, I think the process is probably a little bit different from a diligence and other perspective than if we're trying to vertically integrate and go into a different market. I would say if we're trying to do that, the focus is certainly on, integration could take a while. Who's going to run that business? Does someone there have the expertise that maybe someone in the family business that's making the acquisition doesn't have, or that they can bring some additional expertise into a business or a line of business where certainly from having to deal with that industry, but maybe don't have the expertise from actually participating in that industry. So, we see both. It depends on the goals of the business and the family. But I would say the approach, from a financial perspective is probably the same, but from a diligence and others and legal perspective, there may be some subtle differences as to how to proceed, whether it's a competitor or something else.
Yeah, I would just add, businesses should try, or families should try to stick with what they do best. I think I said that in my opening remarks. I'm seeing a lot of success with being able to do roll-ups of smaller companies that are just in the same industry, and a larger company brings some value, maybe some synergies, economies of scale, and expertise to help a smaller company where maybe the owner's looking to retire or whatnot with that. And, the appealing thing for a family that's buying a company is the longer term hold period and nature, and just the whole overall, treating a company like it's your family, where a PE firm is never going to come across like that to a potential buyer who wants to take care of their employees, make sure that their employees, won't end up on the chopping block in a few years, or as Paul said, that there's a 5 to 7 year hold period in a lot of cases. So they could be turned over in less than 5 years with a whole new owner that they didn't necessarily sign up for. So there's a lot of reasons to kind of do it yourself, and there's really some competitive advantages a family can bring to the table to attract good businesses that are looking for a family-owned business to acquire them.
Thanks, Brian. In your experience, Brian, companies growing, they can reinvest in their company and continue to grow, at a point that growth may stagnate, and their alternative would be to buy another company or perhaps just distribute the funds to the family members for whatever purpose they want. What's that tipping point? At what point do you start to see a company that they're overcapitalized? Which, for a banker to say something's overcapitalized, that's what we want to see. But from a efficiency standpoint of the family holdings, at what point do you think they should start looking for alternative investments?
Well, talking to your banker and your investment advisors, it's all about the return on investment. And if you're not generating the income or the dividends off the business by keeping the cash sitting there, then your alternatives are to dividend it out and let each investor or each family member figure out what they want to do with that, or ideally put together kind of a family office support or service leadership team and advisory council, and be more strategic about what to do with the extra cash that the business is generating, and have a strategic game plan to diversify the business and diversify those holdings to get the best return on investment.
Well, what are your thoughts on that?
Yeah, I would say that Brian mentioned, having the support, sort of building, whether it's an investment council, whether it's a family board that might have some outside advisors as well as just the family members on the board. I think if a family wants to do some acquisitions and hasn't done them yet, or has sort of been on the fringes but hasn't really gone in head first, I would certainly try to maybe either, whether it's through an advisory committee or advisory board, bring in some other family-owned business executives or shareholders who have been on the acquiring side, and sort of pick their brains and see why did they do things, what were their successes, what were their pitfalls, and really sort of vet the process. Because for those familiar with the process, you sort of know the ups and downs and when to expect things to be, things can be riding high one week and the next week they look like the world's falling apart, right? And you're spending money along the way. So I'd say for those who are not necessarily as seasoned at M&A deals but want to try to embark on the process, certainly talk to other business owners and find out how, especially what their pluses and minuses, and just generally what the process is. Because, acquiring a company or selling the company for that matter, you just don't turn the lights on one day and it happens. And it takes a lot of planning. It takes a lot of, use of your professionals, your commercial banker, your accounting firm, really to dig in and see how are things going to fit, who's going to do what tasks, what segment of the business is going to be focused on doing deals versus running the business, because that might detract from people being able to do it. So, there's a lot of things. I think if you're going to go out to do something on an acquisition side, have some infrastructure built around that team and kind of play out how it's going to work.
Yeah, finding the company is one challenge, then merging and integrating it into the business is another.
Ryan, have you seen situations where that did not turn out as planned?
I'd say the first one usually is always the hardest, and you've got to do the first one before you can do 10 or 20. So you've got to, as Paul said, putting the right team in place to help you go through the process and getting as much advice as you can before you do it to prepare for it is really important. I mean, I could go through a list of war stories, and I'm sure Paul can also attest to a lot of litigation that comes out of some of these transactions when things don't work out the right way either. And you don't want to end up in those situations. So, bringing in the right advisors. Again, we talked about the competition out there. Private equity firms, they're using the best of the best. They've got very smart people making decisions, searching for the right companies to buy. They've got experience. Most of them have experience integrating acquisitions. And so, it's not undaunting. A family office or a family brings a lot of value to the table, and a lot of companies want to know that a family is buying them. So there's a competitive advantage, as I said, to go out to the marketplace looking for these. And there's also a lot of companies that are looking to sell. So there's a statistic out there that with the baby boomer generation, 7 out of 10 privately held businesses are going to go through some level of an exit or a succession plan in the next 10 years. So there's plenty of companies that are looking to figure out what to do for their next generation or for their employees to protect them. So there's lots of opportunities out there.
You both have touched on the family aspect of the acquisition. I would think that if the ownership of the current company is tightly held, it's a much easier decision process to go down that path. If this ownership is widely held, getting the other family members on board with retaining capital to fund future growth is always a struggle, as we know.
Joe, I would chime in and say that's absolutely the case. And it's interesting that I think you kind of look at the family dynamic actually on both sides of the coin. So certainly from the buy side, and that's the focus of today's discussion, you definitely want to focus on what's the procedure going to be, and again, is it a subset or a subgroup of the owners, depending on how diversified the ownership is of the business. But also, one thing that's kind of intriguing about family-owned businesses buying other family-owned businesses is they can sort of put that other hat on and try to imagine themselves as being approached by someone trying to buy their business, right? And I think sometimes they can be a little more sensitive to what's going on in the selling family's life versus maybe other types of institutional buyers who they're in it to win it, they're in it for the money, and it might not necessarily be a personal connection that the family business owner from the buy side can make with the sell side. And one thing to consider is that target company, how diversified is their ownership, and what kind of mountains might they need to climb to approve a sale. And so, from the buy side, that becomes your problem, because you may have a really nice seller, but if he can only get 75% of the people to sell, that's a problem. And so it's you sort of see it from both sides. And I think from a family business owner's perspective, you can sort of put that hat on a little easier as to, okay, I'm approaching another family business owner, how best to talk to them, how best to get a rapport with them. And I think that is important.
Yeah, I'm just been smiling here because I think of some of the family dynamics and some of the transactions I've been involved in on both the buy and the sell side, that it does really require probably an independent advisor to help a family think through these processes, because the best acquisition opportunity to diversify the wealth might be sitting right in front of a family, but there might be a couple siblings who do not want to put any money at risk, others that want to, just to work through that. And then I think, I'm sure Paul can attest to this as well. I mean, you've always got to have an exit strategy too as you go into an acquisition, and your own businesses too, because divorces happen, and I say divorces, I mean breakups where two business owners, you have to think through the pros and cons that someday it may not work out, or somebody might die suddenly, and now you're dealing with a spouse or a sibling or a child of the business, and you've got to figure out how do you make things work. So you've got to be thinking through all the repercussions that could happen as you're going down this path of starting to buy businesses, or think about what could happen for estate planning purposes down the road.
And Bryan, you touched on the planning. I think a key part of planning is, and it sounds self-serving, but is your chief financial officer capable of guiding that process and perhaps helping out in another line of business that's not your current line of business?
Yeah, so my current my prior background was that of being a CFO, a controller, CFO, and then CEO for 4 different types of businesses, private equity owned, family office owned, and public companies. And not all CFOs are created alike. And so you have to understand, do you have the expertise in-house, not just from the financial side, but also the operational side, to help integrate and merge the business in? Because a lot of things can go wrong. But the good news is there's plenty of professionals out there that can help you navigate through this. Hopefully the CFO understands that, his job is not necessarily, his or her job is not necessarily threatened by bringing in a professional to help them go through the transaction. It can make their lives a lot easier, especially if they require an audit down the road or have bank covenants that they need to make sure they don't trip. Just making sure that they've got somebody with the experience to walk them through the process.
And Paul, that would carry over to the legal side. I have seen instances where the target company does not have the best legal representation. Maybe it's a general business counsel and not a transaction attorney, and they really aren't familiar with the process and what's involved. So how do you make sure that the target company has the right representation and you're talking to the right people?
Yeah, I mean, to the extent possible, you're right, Joe. A general practitioner oftentimes, will go down the primrose path with a family-owned business, and there's absolutely nothing wrong with that. It's oftentimes, a general practitioner who becomes a very good confidant of the family, good friends, a friendship as well as a business relationship, and so we see that. And one thing you don't want to do necessarily if you're on the sell side is necessarily rock the boat with that relationship on the one hand. On the other hand, though, I think, once, depending on the size of the firm that you're looking at, depending on the size of the deal, I think a general practitioner is going to realize quickly that they don't have the capabilities of handling the diligence request and the documentation request and making changes. And oftentimes from the buy side, you have a nice tight unit of financial advisors, legal advisors, and they're going to be looking for answers. They're going to be looking for responses. And oftentimes you need to keep, a good pace to a deal, right? You need to keep momentum. And, as we say, the biggest thing that kills deals is time. The more time that goes by, the less likely or the more likely a seller might be able to, think about it too much and not want to do the deal. So, that can happen. And I think these are some things that you kind of want to get to know early on. And, from a family owner's perspective or family business owner's perspective on the buy side, you're probably not going to be focused on, you're not going to be asking yourself, I wonder who represents that seller, or, I wonder what kind of advisors they have. Does that even really matter? And the answer, Joe, is yes, it does matter. And, oftentimes you see on the buy side, and it's not just family-owned businesses, where they want to get into the process as quickly as possible and as deep as possible and keep their costs down. Understandable. So what does that mean? That means we don't want to really bring in the lawyer. We don't want to bring in the accounting firm just yet. Let's get as far down the road as we can, and we can keep those costs to a minimum. Again, nothing wrong with that necessarily, except that if there are sort of small time bombs or ticking time bombs on the sell side, the sooner you can identify those things, the better. And I would put in that category, who are the representatives of this seller? I would ask who their legal is. I would ask who their accounting firm is, and you're going to know that probably by seeing financial statements early on, and who their commercial banker is, and if they have an investment banker. I mean, those are four simple questions that whether you have representation or not on the buy side, you got to put those on your short list. And anybody you're talking to, you want to ask those questions quickly and up front to get a sense of sort of who you're up against, so to speak.
Sounds good. Maybe if Twitter and Elon Musk had that kind of insight, they wouldn't be where they are today. Mike, do we have any questions from the audience?
So we get a question again. Just a quick reminder: type of question right into the chat. We'll go ahead and ask that to our panel here. A story without naming names.
Hey, Joe, can you repeat the question?
Sure. Can you share a success story without naming names?
I mean, I've been working the transaction field now for almost 9 years, and I could name a bunch of them. The first two that come to mind were operators in the business that had devoted their whole career to helping build the business, and the owner had health problems. In both cases, in one, the owner passed away, and they brought me in to help. The operator of the business brought me in to help acquire the business, and in both cases, they brought their family then into the business to do more in that business, and they became very successful family businesses. And those are the types of projects that I just love to help a business owner, a private owner, a family work through, because just to see the success of helping negotiate the deal and helping do the due diligence, bringing in the tax expertise, working with great attorneys to help realize that you're helping a family who put in, or a person who put in 20 years trying to build a business for somebody else. Now they get to reap the benefits of that.
Sure, Joe. One family business I have in mind, been working with for a pretty long time, and along the way, they have found opportunities. They found opportunities through locations that they leased that those owners decided they wanted to sell. And so, you go and you buy the facility and you buy the equipment and you go ahead and just buy that operation and swallow it up, as opposed to leasing a significant portion of it. Also where they've had joint ventures with organizations, sort of in their primary line and then sort of on ancillary lines of business, where they bought out the joint venture partner. And that's one where you sort of know the business a little bit already, which is very helpful because you've done it in a joint venture fashion. But it's time. They just decided it's time to buy them out and just put this under one umbrella. And oftentimes that joint venture partner sometimes gets worn out and they just want to get out of the business. They want to maybe exit, focus on something different. So the one client I have in mind, we've done a series, both of those areas, sort of a series of those types of acquisitions over the last probably 10 years. And some of them, they've ended up with real estate, which can be good and bad. But, that's another aspect where money can be deployed. And, you sort of own that facility. And down the road, maybe you shut down that facility, but you can always sell the real estate. And so, it's sort of another alternative investment, so to speak, or alternative, but an additional investment that the family can make into sort of diversifying a little bit what their holdings are. So that client's, I can think of several, and all those acquisitions, I would say they've all done fine. I can't say any have been a huge home run on the one hand, but they've all, added to the business and helped them incrementally grow. Not a home run overnight or within a year, but over the last 10 years, they've seen some nice, very nice incremental growth.
Well, it's a great point on the joint venture. It's a relatively lower cost of entry into the acquisition. You're not all in, and you get time to explore the new business and make sure it's a fit before you complete the transaction. So I like the idea of a joint venture as a structure for expansion.
Yeah, what this company found was these were manufacturing plants where, the other joint venture party wanted a product manufacturer, didn't have the expertise, but our client did. And the other party was willing to build out a facility to get it done because they wanted to build it in their backyard so that it would be close. And the way in the ingredients and things that they used, it was necessary for the location to be close to the joint venture party's location. So they would go out and they would build the facility, and our guys would come in and agree to run it. They'd lease it and they'd run it for a certain period of time. And, pricing became a big issue, and there's a lot of ancillary issues that go into that. But again, you get to a point where the joint venture partner, just decided they didn't want to be in that segment of the business. However, they were still kicking out some of these ingredients that somebody needed to buy. So, our guys would go in and just buy them out. But yeah, those opportunities present themselves. I can't say we see them often enough, quite frankly. I think that there's ways to structure those to get both parties, sort of half into bed together, and then, maybe one party decides to buy the other one out.
I can think of a horror story that I was involved in that one part of the joint venture was bringing technology and the other part was bringing manufacturing. And in the end, the manufacturing group blamed the technology and the technology group blamed the manufacturing of how it was implemented. It didn't work out real well.
Yeah, they don't all run well, that's for sure. But, I think going into it, again, it's all, there's intellectual property issues and sort of who owns what. And there's a lot of things that companies don't necessarily want to cross that bridge. And a lot of them will just say, if I'm going to do it, I just want to do it myself. Sometimes it's just easier to go do it yourself. And sometimes it is. But these, from a geographical perspective, were helpful. And it sort of helped our client not have to go out and borrow the money and actually build the facility as much as just run it, operate it, and down the road have an option to do all that. So it's a little bit less capital intensive for our client up front, and on the back end, maybe still having an opportunity to seize that opportunity down the road.
That was great. Mike, any questions, or have we covered everybody's?
So they kind of touched on the last question that we have as well, really having to do with what mistakes are you seeing, in particular when they're a larger family business acquiring a smaller one, or if they flat out fail. What's kind of the biggest reason for failure?
I think I got most of that about mistakes and lessons learned potentially. I think Paul covered a lot of that too, about trying to uncover the issues up front, especially with a small family-owned business. A couple of things I've seen is, as we were doing the diligence, our tax experts pointed out that the owner selling the business was going to have a big tax issue and didn't have the right tax advisor helping them. And the investment banker, when we brought it to their attention, basically said, "You're not authorized to tell my client that he has a tax issue." And in the end, it pretty much killed the deal once that owner figured out that he was not going to put as much cash in his pocket as he was being told in advance by his investment banker and his accountant who was helping advise him early on. But once he brought in the right experts, then he figured it out. And I think it goes to Paul's saying is, sometimes you think you're going to get a better deal by swooping in and just buying a business owner on a handshake, but a lot of times you do hope that they have good professional advisors helping them. And the sooner you can kind of identify the pitfalls and things that could hold up the business, taxes being one of them. I've seen a lot of deals fall through right at the end because of taxes. I'm sure Paul's seen a lot of deals fall through that something came up in the litigation diligence that nobody disclosed early on. That's why it pays to, bring in the right professionals and try to uncover those things as soon as possible, because sometimes the best deal is the one that doesn't get made.
I would say from the buyer's perspective, oftentimes it's, having a strategy going into a deal. So, what's my strategy if I'm going to be on the acquisition side? And that strategy oftentimes, it can be driven by tax. It can be driven by assumption of liability issues. It can be driven by, a host of things. But I would say, from the legal perspective as an advisor to a buyer, we would typically, our knee-jerk reaction typically is, you want to buy the assets of that business. You want to set up a new separate entity to house those assets. You want to bifurcate it from the rest of your business and own it and run it for a year or two to make sure there's no lingering liabilities out there. So let's go in and let's present an asset purchase and let's see, how that goes. And as Bryan just rightly pointed out, that asset purchase can be detrimental to a seller, especially the owner of a C corporation, and that's just never going to, and that seller, it's just not going to fly. It might fly, but there might be a significant purchase price adjustment to help cover tax liability. I don't want to dig too deep here, but those are the kind of things, if you just think overall strategy and structure, right? So the buyer wants to come in with a strategy and structure on how to acquire this business. That seller, don't be surprised if their strategy and structure is not exactly the same as the buyers, right? And so there's always a tug of war. There's always a push and shove between the buyers and the sellers, as Bryan pointed out, on tax issues, on assumption of liability issues, working capital, other things, where we know, companies that do these acquisitions often will know what those hot buttons are. You're going to learn what they are over time. The professionals are going to know them before the deal even starts. I mean, we can almost predict what can be the issues and how to diffuse those. And so if I'm on the buy side, I want to get into my buyers' heads and let's figure that out. Let's try to diffuse those issues to start to try to make it a smoother deal.
All right, and we did get another question in here. It says, for family businesses looking to sell, what kind of resources are out there to help the sellers find family offices that are buying?
Well, there's, as I said earlier on, there's more family offices now buying businesses than private equity firms that are in the marketplace. My firm, my private equity industry group, also focuses on family offices. So we have a number of contacts that we've worked with as clients, or just that we run into as we go to conferences across the country. Law firms have really good clients as well, let's fit the same boat. That's always some of the first questions, I think, is people reach out to their accountants and lawyers. There's always investment bankers and obviously bankers have clients as well. So there's a lot of resources out there to reach out to, and we're always open to making a referral in hopes that it works out as a win-win.
Yeah, I think the sensitive issue there is probably confidentiality, right? So you want, as a seller, as a family maybe contemplating selling, your first reaction is, I don't want to tell anybody because I can't let the cat out of the bag. And that's a very valid concern and a very valid point. And that's why, if you're looking for who might be interested, there's a host of your advisors who I think would be trusted confidential advisors, right? People, if you go to them and sit down and say, this is kind of what I'm thinking, they can very discreetly, if someone comes to me, I can make a call to so-and-so family office where I have a contact or so-and-so and discreetly describe that business, whether it's by industry, maybe by financials, here's kind of where they fall revenue-wise, EBITDA-wise, here's kind of their customer concentration, without identifying who they are. And I don't even necessarily have to identify maybe the geographical region they're in. And so there's ways to do that, sort of soft pedal it, so to speak, to start to see who might be a good fit. And then, kind of go down the path a little deeper to where at some point you are going to have to disclose who you are as a seller. But there's other ways to keep things confidential, identity of customers. There's things you can do to, balance that need for confidentiality versus, hey, I kind of maybe want to get the word out there and drum up some interest.
All right, very good. So that was the last question. And before Joe wraps us up, I do just want to give a quick reminder. A survey is going to pop up when you leave the session. Please do take just a moment to fill that out. It really does help us provide a better service to you. And with that said, I'm going to pass it back to Joe.
Paul and Bryan, thanks for a lot of great information. And to our audience, if you have questions for Bryan or Paul, I will post their contact information on our website. Please feel free to reach out to them with more detailed or perhaps confidential questions. And Bryan, thanks. It's a great segue into next month's webinar on family offices. So please join us then. You'll get an invitation to that coming out soon. So gentlemen, have a great day. Thank you very much for being a part of this.
Thanks,
Joe. Take care, Bryan.
All right. Bye, Paul, Joe.